was around credit market and some other risk topics, which are also quite topical these days, and are impacted by where we see a lot of innovation going on, and SAS is investing quite a bit of time and effort into it. So just to level set again, right? Because so you can ignore the bottom part. This is the insurance, because we do a lot of work in insurance as well, but let's not worry about that today. On the top part, the banking solutions that we generally work on, expected credit loss, scenario and stress testing, reg capital, asset management, risk platform transformation. There's a mishmash of things, model risk management, decisioning, and so on. And of course, we have added two other things, like the Kamakura ALM and the data piece that we talked about already. Nothing new there. So what I'm going to do is I'm going to just skip to three things which are, I think, topical. And so just to kind of remind you, one is, expect credit loss. I won't spend time on it because I think you've already done that. And all I will say is that what we see in banks today is that firms are using our solution, of course, or some other solution, sometimes in-house, but they continue to improve on how these things work, because one of the things we talked about is that some of the models have to be revamped, updated, if you will. The workflows have to be tightened up. Process integration, performance, these are all things that are relevant. So people continue to invest in that solution, and so are we. So one point of interest that may come up here is that our expected credit loss, this solution is still not on VIA that we have been talking. So this is still on our non-VIA platform, right? The expectation is that it'll go onto the VIA platform eventually, maybe next year. We're already working on it, so we don't have a date for it yet, but it will go. Everything that you see here will go onto VIA. We will focus a little bit on the scenario stress testing piece, which essentially has, if you can think about it, two pieces. One, the ICAP process, which is essentially around generating risk aggregation and your economic capital calculation, right? And of course, more regulatory-driven reg capital kind of process. One is obviously the EBA, which is the European standard, and then CCAR, which is the US standard for stress testing, right? So we cover all these areas, and these are all available. We're investing on it. A lot of customers are using them, but they will all eventually end up in the VIA platform, right? But the point that I made before last time when I was talking to you guys is that the output of these processes eventually end up into that integrated balance sheet that we talked about, right? So there are ways to pull it even today, right? It's just that they're not all in one place, but these systems, as they evolve, will integrate with each other. And then we'll talk about market risk a little bit, very briefly, and climate risk, and enterprise risk governance. So I'm going to skip this part because I don't think it's quite important here. Just skip this part. Okay, I'm going to get right here. There are a lot of details here, but I don't want to get into all of it because the most important thing is if you watch the 6 blocks here, right? So Basel III, we'll be talking hopefully, or will come up in a discussion. Basel III is obviously a very relevant topic. Now it's Basel IV, the information of Basel III regulations. This Bank of England stress testing. There is obviously the Dodd-Frank stress testing piece. all these pieces need to be come together. Now, I don't know how much you know about the, let's say, I'll take an example, the CCAR process. So in the CCAR process, if you notice what happens, and the rules are essentially that you essentially project your balance sheet for 9 quarters out, right? I mean, everybody's doing some form of that under different scenarios. So in CCAR, you're essentially given scenarios by the regulators, the Fed, and you project your balance sheet for 9 quarters. You take into account your possible originations of loans. You have to assume, compute the losses that you have from those loans, the origination loans, and what you have in your books. You look at how your deposits are going to evolve, and you obviously look at your fees that are going to evolve, right? So you essentially use all these elements to understand your capital impact. Now, and obviously the main idea here is that, in your capital submissions process, you have to, how much dividend you can pay, what are your payback, your buyback provisions. If they don't meet, obviously, the threshold, then you fail the CCAR test. No one wants to do that. So CCAR is generally done by the top 36 US banks, but there's different forms of CCAR that other smaller banks have to do, which are less arduous, but nonetheless, what's really the trend in the market, and why this is a topic of topical interest here, is that although initially most of the banks, and even the banks I was working for in my past, in the recent past, I worked for 2 large CCAR banks. There was a lot of, the general thinking was it was essentially being forced by regulators down your throat, right? But I think the general realization now is that it has actually made the bank stronger. And even the internal management now obviously feels the same way, that there's a certain amount of rigor that this has brought. So essentially, the relevance to the topic of innovation and modernization here is that although all these banks have met the requirements, they continue to invest into the process because it is helping them actually run the bank more efficiently. And to run this more efficiently, banks feel that they need to keep innovating these processes that may have met the regulatory standards, right? But it is necessary, but it's not sufficient for their purposes. So they keep on evolving their systems. And that's why SAS, as a firm, we continue to invest in these solutions because there are all these changes, right? But also the feedback from customers is that we really want this to work for us in a more efficient and automated fashion, right? So that is the real trend here. And I forgot to mention that the interest is just not at the management level. The interest really is at a board level. So the mandate is at a much higher level than a department or even a chief risk officer reporting to the board directly, and therefore these are being expected for the firms to meet. And then the 3 quick things here again is to reconfirm is that, of course, there's regulatory stress testing, right, to make sure that your capital standards are in line with your regulatory expectations. But this also internal piece where obviously you're looking at how these numbers that you generate could be used to allocate your resources correctly, right? So you can actually keep the profitability you expect. So your internal cap process, if you like. And then finally, as we said earlier on, that both your economic capital process, which is driving how you want to generate, how you want to run the bank and the regulatory standard that you have to meet, how those 2 pieces are connected very much with the other processes which are not typically considered risk. The FP&A process, for example, how you create the budgets, they are very intertwined. And therefore, the innovation in all these individual areas connect eventually. So if you just look at one piece and you just think about that piece as the piece which is going to get evolved, it's not going to evolve unless you move all the pieces together. So they have to move in tandem. You can't just move one piece and assume that you can evolve and modernize that piece, because that piece is connected to all the other pieces, right? So that is the main idea behind this innovation. So I'm going to skip these parts. I mean, this is not really. We have already covered these points, so I don't want to mention this again. So I'm just going to quickly go through a couple of key ideas. I mean, this is the piece that maybe is important to kind of mention in this box here. Just a review that if you look at the stress testing process, you can call it synthesis process. Look at the pieces that are relevant, right? The workflow can be quite complicated, because if you don't have a proper automated workflow, essentially you're doing a lot of manual touches, which creates not only inefficiencies but inaccuracies, right? So you really want to overcome that process. The data that you marshal comes from various parts. So therefore, the data sourcing piece is a critical piece to the puzzle. How you manage scenarios, another big area to focus on. What models do you build, right? Because you could have a Monte Carlo process, you could have Markov transition process. We support all these, by the way. All these things that you have, the models that you build and how you execute, the templates, that's a big part, right? And also model risk management we talked about earlier on. Once you estimate the numbers, then you have expert judgment numbers. So the business units, so how do you do that? How does the first line communicate what their expectation of the numbers are, and how do you do the business challenge process? That's a big part, right? The overlays and the review process, the aggregation, the weighted assets calculation, reporting, the CFO attestation, all these things are quite complicated, and they are all evolving. So in order to be able to really achieve the level of automation, what has to happen is all these pieces will have to be addressed at the same time. You can't say, I'm going to work on one and forget about the other, because if you do that, you can do that. But if you do that, what you're not going to achieve is you're not going to achieve the automation they're looking for. So essentially, you have to think about all these elements. You might decide that some you'll evolve now and some evolve later on, but you have to keep this very deliberately mindful of, so that you know that overall you can achieve what you set out to do. So I think we're going to skip this piece here. These are, I'm just going to quickly go through. This is another point I really want to quickly say, is this, that the business evolution, so how you see, so you start on T0, but how you essentially think about how your business is going to evolve, right, is a very, it can be quite a challenging process, right? Because each unit, each line of business, their assumptions need to be understood, verified, and brought into the system. So the business evolution process is an extremely complicated process. So these are things that are built into the solution that we have. So it doesn't mean that, so you obviously don't have to do CCAR or DFAST, because these are not relevant for your market. But what is important to remember here, and I think is that these are sophisticated workflow templates that we have built for our customers over many years, right? So if you wanted to take that as a starting point and customize it for yourself, depending on what you are supposed to do or what you plan to do, it is doable. So you don't have to start from scratch. So we have very sophisticated workflows that we already built out, but these are all customizable. So you can actually make some of them simpler, or you can modify and customize for your purposes to fit your market and needs. And that is the message I want to relay to you, is that if you want to achieve something, you don't have to start from scratch. It's kind of there, it's verified, it's vetted, it works. So now you can just have to customize it. And then these are some of the things, like, you want to compare, you may have two business plan assumptions, and you want to see under the two different plans how your capital structure may look like. You could do that in the system. We already covered that we can, cover different sorts of models, different types of rates, and these are all pre-built in the system. One of the important things in scenario analysis stress testing, obviously, is attributions. You want to know what the drivers were, right? How can you attribute your results? That's built, and it's a pretty complicated thing to build. It's pre-built into the system, so that helps your evolution process. Sensitivity, right? What risk factors are driving the loss process is another important element that's critical, right? It's pre-built in the system with all the visualizations. Back testing, again, very important aspect of the scenario stress testing process. Again, pre-built in the system. So, I can keep going on and on, but the basic idea is this: that before we go talk about climate, the main point I think I want to leave you with is that I gave you some examples of the types of stress testing we have done, right? These are all, in some ways, I should say scenario analysis and stress testing. So we have some regulatory ones from Europe, some from US and other places, and we have evolved them over many years. And what we have, I wouldn't say, nothing is 100% because things always change, but we have a very rich set of functionality that is already pre-built in the system. And the real advantage is that you could take one of them, which kind of makes sense for you, and you customize it for your purposes, and then that's what gives you the acceleration that you need to get where you want, right? Now, this is just a case in point exactly of what I was saying. So if you look at climate risk, so there's a lot so we have to kind of understand climate risk and ESG as separate items, right? So if you just look at the impact of climate risk on your portfolio, there are two aspects, right? One is the physical risk of something happening and that impacting your firm, and that you capture generally through your operational risk process. The other one is the transition risk. So as the regimes change, right, how would that impact the valuation of your portfolio? And there are two parts to it. One is the credit part and one is the market part. So I'm talking about the credit part in this case right now, is that the system we have allows you, and I will go into a little bit of detail right now, is that allows you to take physical factors, because one problem with climate risk, of course, is that there's a lot of questions around the data. But there are some sources, NSG is one of them. There's some places where you can get some of the data. But if you are able to take your data, the actual climate change data, and you can convert them into macro factors, which are driving your models, that allows you to understand the impact of climate change on the portfolio. So in other words, let's say you can loan to farmers, and they are in a region which is flood prone, right? Now you want to understand what is the likelihood and to what extent that portfolio will be impacted, or how risky is it for default or not default, for valuation loss for that to happen. Or you can loan to automotive firms which are now subjected to some climate risk factors, right? You don't have to build something separate. What the good thing about SAS's stress testing solution is that it is possible, and we're working with some customers on being able to incorporate that into their current system. SAS just allows you to incorporate that into the system with some extra configuration. You don't have to rebuild the entire system. So it's just another example of what I was saying earlier on, which is we have workflows which may be specific for a market or a certain regulation, but you could take that and you can tweak and customize it for your purposes. Any questions before I go further? I'm going to skip this part a little bit, and maybe this is so I already covered that part. This is the one I want to talk about. But any questions before I go further? Okay. All right, so So this is essentially, I kind of already kind of said this in words, but let me kind of go through this a little slowly, and hopefully this will. So if you look at the very left, right, these are the climate model variables, let's say, right, temperature, and and so on. We convert those physical risk factors into some of the factor components, which we let's call that emissions, revenue. How will this impact these factors, right? And then the next step is to create a sensitivity map. Now this you could model it yourself, right? You could have correlation tables, and you could run some statistical models on top of things what you have. Or you could have expert judgment, or you could have a combination of the two. It's very similar to the way stress testing is done. You could have a model, but then you could overlay that with expert judgment, right? But if you look at these numbers, these are the factors, right? These are the factors: emissions, revenue, investment impact, physical impact. They all add up to one, of course, right? They'll add up to one. And then you can use that factor impact on top of your portfolio to understand the impact, the credit quality that will go down in your book. And that is what you capture through your climate risk factor. So in other words, what happens is you can use your scenario stress testing architecture to incorporate the impact of climate to understand from a credit standpoint, right? Of course, there's another piece, which is for the trading book, you may have to do market risk, like a climate VAR, if you like, right? We're actually working on something like that. It's not quite ready, but this one is. So the credit part we can capture today. So this is the transition risk of climate on your books, right? So it's part of the SaaS solution suite. So what's the main point? The main point is that as you start thinking about how to evolve your risk processes and therefore your finance processes to be able to capture all the types of risks that are changing, getting added. We are keeping up with the solution set, the risk factors that people are dealing with to make sure that our customers are getting the value that they expect from the investments. These are some of the views, to be honest. I mean, I think we can just go past these. So again, to be able to, it's just not the final number that makes sense in risk. It's often about attribution, which is a very, very complicated process. Because if you don't understand where the risk is coming from, it's not really that useful, right? To be perfectly honest, I can give a number 100 and say that's a loss. But if I can't explain how that I got the number and what is driving the number, then it's not really that terribly helpful. The attribution process we have pre-built is that what allows us to do that. And it's also part of the solution suite. Sorry. I'll go to the next one, which is the regulatory capital. I'm going to skip this part a little bit because I think we kind of understand, but we continue to invest in that. The piece which is the other important, of course, this is, you keep investing on it, and I'll skip the market risk part as well because we already talked about that during the ALM conversation that, because if you look at asset liability management, you have to take into account all sorts of risk factors, including market risk. And we have the solution set. So all sorts of market risk. Whether you see an expected shortfall and VAR of different historical VAR, Monte Carlo VAR, and parametric VAR. We do all sorts of things in our system. So it's all in one place. The real other trend that that's is very relevant right now is on the controls factor, the compliance and controls factor. So because of the types of risks that are changing, one of the things that many of our customers are grappling with is how to make sure that all these things they're computing and monitoring, how they can make sure that they are in compliance of their own standards and regulatory standards, right? So this is a very, very critical area. Like operational risk has become a very big area. And we talked about, I think, ESG earlier on, right? So, you say you have this and your compliance standard says this, but then the question is, if you can't aggregate the results in one place and look at it and have confidence in what you have, that's a real problem, right? So what SaaS does is that it is able to provide you, when I say SaaS, does mean SaaS solutions, what they do is they can provide all the types of risks we looked at a very granular or rolled up level, right? Whether you use a SaaS system implements, SaaS system otherwise, they can be made available. So SaaS has a solution again, which can, I'm just going to go right here. This picture is probably best. So it allows you to, if you look at the round circle, and maybe that's what I'll leave you with, is whether it allows you to collaborate between the first line of business, the line of business, the second line, and the third line. So the audit, the risk management function, and the line of business. They can all collaborate together to make sure that the line of business is maintaining the standards that are expected to do. It is there's an oversight in the middle, in the second line, and the third line can attest to it. So your risk and compliance, the attestation process is complete. So I think my time is up. So I thank you for your time, and I'm very glad I was able to come here today. Thank you.